Welcome. Today, we're diving into the Social Security wage base, a concept that plays a big role in how much you pay in Social Security taxes. If you're a high earner, this is especially important for you. The wage base sets a cap on the amount of your income that's subject to Social Security tax. Once your earnings hit this limit, you stop paying Social Security tax on any additional income for the year. Understanding this threshold can help you plan your finances and taxes more effectively. Let's break down what the wage base is, how it works, and why it matters, especially for those with higher incomes. The Social Security wage base is the maximum amount of earned income on which you must pay Social Security taxes in a given year. Each year, the government sets this limit, and it can change annually based on inflation and other factors. For example, if the wage base is $160,200, any income you earn above that amount is not subject to Social Security tax. This cap ensures that both employees and employers only pay Social Security taxes up to a certain income level. It's a key part of the Social Security system and affects millions of workers across the country. Let's look at how the wage base functions in practice. Suppose you earn $200,000 in a year, and the wage base is $160,200. You'll pay Social Security tax only on the first $160,200 of your earnings. Any amount above that $39,800 in this case is not taxed for Social Security purposes. This system is designed to limit the amount of Social Security tax paid by high earners while ensuring that everyone contributes up to a certain point. It's important to note that Medicare taxes work differently and don't have a wage base limit. The Social Security wage base isn't a fixed number. Each year, the government reviews and adjusts it, usually increasing it to keep up with inflation and wage growth. This means that the amount of income subject to Social Security tax can go up from year to year. For workers, especially high earners, it's important to stay updated on these changes, as they can affect your tax planning and take-home pay. Employers also need to track these adjustments to ensure accurate payroll processing. The Social Security Administration, SSA, is responsible for setting the wage base each year. They use a formula that takes into account changes in average wages across the country. The SSA announces the new wage base for the upcoming year, usually in October. This gives employers and employees time to prepare for any changes in their payroll and tax obligations. Staying informed about these updates is crucial for accurate financial planning. The Social Security tax rate is currently 6.2% for employees and 6.2% for employers, totaling 12.4%. This rate applies only to income up to the wage base. If you're self-employed, you pay the full 12.4% yourself. Once your earnings exceed the wage base, you no longer pay Social Security tax on the additional income, but you still pay Medicare tax on all your earnings. Understanding these rates helps you see how much you'll contribute each year. Let's compare how Social Security taxes work for employees and self-employed individuals. If you're an employee earning $100,000, you and your employer each pay 6.2% on that amount. If you're self-employed, you pay the full 12.4% on your own. However, both scenarios only apply the tax up to the wage base. This distinction is important for tax planning, especially if you're considering self-employment or running your own business. High earners pay close attention to the Social Security wage base because it directly affects how much they pay in taxes. Once their income surpasses the wage base, they stop paying Social Security tax on additional earnings, which can mean significant tax savings. This makes the wage base a key figure for financial planning, especially for those with variable or high incomes. Knowing when you'll hit the cap can help you anticipate changes in your net pay throughout the year. Once you reach the Social Security wage base during the year, your take-home pay increases because you no longer have Social Security tax withheld from your paycheck. This change can be noticeable, especially for high earners who hit the cap early in the year. It's important to recognize this shift so you can manage your budget and savings accordingly. Planning for this increase can help you make the most of your income. Unlike Social Security tax, Medicare tax does not have a wage-based limit. You continue to pay Medicare tax on all your earnings, no matter how high your income goes. In fact, there's an additional Medicare tax for very high earners. This distinction is important because it means that while your Social Security tax stops at the wage base, your Medicare tax continues, affecting your overall tax burden. Your Social Security benefits in retirement are calculated based on your earnings history, but only up to the wage base for each year. This means that even if you earn more than the wage base, only the income up to that limit counts towards your future benefits. For high earners, this can affect how much they receive in retirement, making it important to understand how the wage base interacts with benefit calculations. Over the years, the Social Security wage base has steadily increased to keep up with rising wages and inflation. For example, in 2000, the wage base was $76,200. while in recent years it has surpassed $160,000. These increases ensure that the Social Security system remains funded and reflects changes in the economy. Understanding this trend can help you anticipate future changes and plan accordingly. The wage base exists to balance the funding of Social Security with fairness for taxpayers. By capping the amount of income subject to Social Security tax, the system ensures that everyone contributes, but high earners aren't taxed indefinitely. This approach helps maintain the program's solvency while recognizing the limits of the benefit formula, which also caps the amount of benefits you can receive. Employers are responsible for tracking each employee's earnings and stopping Social Security tax withholding once the wage base is reached. Payroll systems are designed to automatically adjust, but it's important for both employers and employees to monitor pay stubs and ensure the correct amount is withheld. Mistakes can lead to overpayment or underpayment, so staying vigilant is key. If you work for more than one employer during the year, each employer withholds Social Security tax up to the wage base. This can result in overpayment if your combined earnings exceed the wage base. Fortunately, you can claim a refund for any excess Social Security tax paid when you file your tax return. It's important to keep records of your earnings from all jobs to ensure you get any refund you're owed. Bonuses and other forms of compensation count toward the Social Security wage base. If you receive a large bonus, it could push your total earnings over the wage base limit, stopping Social Security tax withholding for the rest of the year. Understanding how bonuses affect your wage base can help you anticipate changes in your paycheck and tax situation. Deferred compensation, such as contributions to certain retirement plans, may or may not count toward the Social Security wage base, depending on the plan's structure. It's important to understand how your specific compensation package affects your Social Security tax liability. Consulting with a tax advisor can help clarify your situation and ensure you're withholding the correct amount. Stock options and other equity compensation can also impact your Social Security wage base. When you exercise stock options, the value is typically included in your taxable wages, which may push you over the wage base limit. Understanding the timing and tax treatment of these benefits is crucial for high earners who receive equity as part of their compensation. Overtime pay is included in your earnings for Social Security tax purposes. If you work a lot of overtime, it could help you reach the wage base limit faster. This is especially relevant for high earners or those in industries with frequent overtime opportunities. Keeping track of your total earnings, including overtime, is important for understanding your tax situation. Severance pay is generally included in your wages for Social Security tax purposes. If you receive a large severance package, it could push your total earnings over the wage base, ending Social Security tax withholding for the year. Understanding how severance pay is treated can help you anticipate changes in your tax situation if you leave a job. Some non-cash benefits, like certain fringe benefits, may be included in your taxable wages for Social Security purposes. This can affect how quickly you reach the wage base. It's important to review your compensation package and understand which benefits are taxable, so you can accurately estimate your Social Security tax liability. Understanding the Social Security wage base is a key part of tax planning, especially for high earners. By knowing when you'll hit the cap, you can anticipate changes in your take-home pay and adjust your savings or spending accordingly. This knowledge also helps you avoid surprises at tax time and make the most of your income throughout the year. Modern payroll software is designed to automatically track employee earnings and stop Social Security tax withholding once the wage base is reached. This automation reduces errors and ensures compliance with tax laws. However, it's still important for both employers and employees to review pay stubs and confirm that the correct amounts are being withheld. While the Social Security wage base applies to federal taxes, some states have their own wage bases for state unemployment or disability insurance taxes. These limits may differ from the federal wage base, so it's important to understand the rules in your state. This can affect your overall tax liability and payroll deductions. If you work in the U.S. as a non-citizen or have income from abroad, the Social Security wage base still applies to your U.S. earnings. However, international tax treaties and totalization agreements may affect your Social Security tax obligation. It's important to consult with a tax professional if you have international income or work arrangements. Contributions to retirement plans like 401ks are generally made on a pre-tax basis, but Social Security tax is still calculated on your gross wages before these contributions. This means that even if you contribute a large amount to your 401k, it doesn't reduce the amount of your income subject to Social Security tax up to the wage base. If you overpay Social Security tax, often due to having multiple employers, you can claim a refund when you file your federal tax return. The IRS provides instructions for calculating and claiming this refund. Keeping accurate records of your earnings and withholdings is essential to ensure you receive any money you're owed. Your annual Social Security statement shows your earnings history and how much you've paid in Social Security taxes each year. Reviewing this statement can help you confirm that your earnings up to the wage base have been properly reported. This is important for ensuring you receive the correct benefits in retirement. The Social Security wage base plays a critical role in funding the Social Security program. By capping the amount of income subject to tax, the system balances the need for revenue with fairness for taxpayers. The wage base ensures that the program remains solvent while limiting the tax burden on high earners. Congress has the authority to change the Social Security wage base through legislation. In the past, lawmakers have increased the wage base to ensure adequate funding for the program. Future changes could impact how much you pay in taxes and how much you receive in benefits. Staying informed about legislative developments is important for long-term planning. The wage base is a key factor in the long-term solvency of Social Security. By adjusting the wage base over time, the government can help ensure that the program has enough funding to pay benefits to future retirees. This makes the wage base an important tool for maintaining the health of the Social Security system. Discussions about Social Security reform often include proposals to raise or eliminate the wage base. Some argue that increasing the cap would strengthen the program's finances, while others believe it could discourage high earners. Understanding these debates can help you anticipate potential changes and their impact on your taxes and benefits. Social Security taxes collected up to the wage base are deposited into the Social Security Trust Fund, which is used to pay benefits to retirees and other eligible individuals. The wage base helps determine how much revenue flows into the trust fund each year, making it a crucial part of the system's financial structure. For employers, the wage base affects total payroll costs. Once an employee's earnings exceed the wage base, the employer no longer pays Social Security tax on additional wages. This can impact budgeting and compensation planning, especially for companies with many high-earning employees. Some employee benefits, like certain types of insurance or retirement contributions, may be affected by the wage base. For example, Social Security tax is not withheld on income above the wage base, but other benefit calculations may still use total compensation. Understanding these differences is important for maximizing your benefits. For households with multiple high earners, understanding the wage base is even more important. Each individual's earnings are subject to the wage base separately, so both spouses may hit the cap in the same year. This can affect household budgeting, tax planning, and overall financial strategy. Mistakes in tracking the wage base can lead to over or under withholding of Social Security tax. Overpayments can be refunded, but underpayments may result in penalties. Regularly reviewing your pay stubs and tax documents helps catch errors early and ensures compliance with tax laws. When you file your federal tax return, you'll report your total earnings and Social Security tax paid. If you've overpaid due to multiple employers, you can claim a refund. Accurate reporting ensures you pay only what you owe and receive any refunds you're entitled to. Your Social Security statement provides a record of your earnings up to the wage base for each year. Reviewing this statement helps you confirm that your income has been reported correctly, which is essential for calculating your future benefits. If you spot any errors, contact the Social Security Administration to have them corrected. Experts project that the Social Security wage base will continue to rise in the coming years, reflecting increases in average wages and inflation. Staying informed about these changes can help you plan for future tax liabilities and retirement benefits. Keeping an eye on projections allows you to adjust your financial strategy as needed. Some proposals to reform Social Security include raising or eliminating the wage base to increase funding for the program. These changes could significantly impact high earners, both in terms of taxes paid and benefits received. Understanding the potential impact of reform proposals is important for long-term financial planning. For high earners, understanding the wage base is essential for effective tax planning. By knowing when you'll hit the cap, you can adjust your savings, spending, and investment strategies. This knowledge helps you make the most of your income and prepare for changes in your tax situation throughout the year. Working with a financial advisor can help you navigate the complexities of the Social Security wage base. Advisors can help you plan for tax changes, maximize your benefits, and ensure you're making the most of your income. Regular check-ins with an advisor can keep your financial plan on track as the wage base changes over time. Understanding the Social Security wage base is a key part of retirement planning. By knowing how your earnings affect your future benefits, you can make informed decisions about saving, investing, and timing your retirement. This knowledge helps you build a secure financial future and avoid surprises down the road. To wrap up, the Social Security wage base is a crucial concept for understanding how much you pay in Social Security taxes and how your future benefits are calculated. High earners should pay special attention to the wage base as it affects tax planning, take-home pay, and retirement strategies. By staying informed and planning ahead, you can make the most of your income and ensure a secure financial future.